Welcome to Griffonomics. Today, we deep dive SLV Energy, trading under the ticker MWH, against its closest utility-scale infrastructure and electrical grid peers.
And this is honestly one of the most fascinating layers of the whole artificial intelligence boom that nobody is really talking about.
Yeah, exactly. I mean, if you just imagine for a second a single massive data center, like one of those giant facilities housing the servers that actually train AI models like ChatGPT.
Right, the real physical footprint of the cloud.
Exactly. That single building can pull as much electricity as, well, basically the entire city of San Francisco.
Which is just staggering when you think about it.
It is. And so imagine the sheer physical panic of trying to build the extension cord for that data center. You don't just plug a hyperscaler into the wall.
No, absolutely not. You need gigawatts of power. You need thousands of acres of land and these massive high-voltage connections that take literal years to engineer.
Right. And so today, we are looking at the company building those massive landscape-altering extension cords. Because here is the central investment tension we are exploring for you today.
Yeah, let's lay it out.
SOLV Energy is capturing this massive structural tailwind driven by unprecedented electricity load growth from AI data centers. But crucially, they function as a capital-light toll booth.
Right, a toll booth for installation and maintenance.
Exactly. They completely avoid the risks of hardware manufacturing. They are immune to technology obsolescence. So whether you are an infrastructure investor, or maybe you're just tracking AI's energy footprint, or you're just insanely curious about the grid.
Which, I mean, you should be.
Yeah, you really should be. This deep dive will reveal the hidden mechanics of how mega-scale power is actually built.
And I think to really understand that toll booth positioning, we have to look at what they do not do.
Okay, what do they not do?
Well, when you look at the broad theme of the renewable transition or this AI power boom, it's really tempting to get drawn toward speculative clean tech hardware manufacturers.
Like the guys building the actual batteries.
Exactly. You might look at companies like EOS Energy or Bloom Energy, right? And they are pouring billions into research and development.
Just hoping to build the next great proprietary battery chemistry.
Yeah, or like an advanced solid-state fuel cell. Or on the completely other end of the spectrum, you might look at residential rooftop installers.
Oh, like Sunrun.
Like Sunrun, exactly, who are dealing with, individual homeowners. But MWH is a completely different beast.
Right.
The mission of this deep dive is really to deconstruct how MWH competes against legacy heavy civil giants by acting as a pure-play renewable filter.
So they aren't making the gear at all.
Not at all. They do not manufacture the solar panels. They do not manufacture the lithium-ion batteries. They literally just charge a massive toll to build them and then another toll to maintain them.
Wow. Okay, but if they are locking in these long-term maintenance contracts, they must be taking on immense upfront risk to actually build the plants, right?
Oh, massive risk.
Yeah.
Which is why scale is so important here.
Right. So before we can even begin to understand the financials or the Up-C stock structure, which we will get to.
Oh, the corporate structure is a whole other crazy story.
It really is. But first, we need to wrap our heads around the sheer physical scale of what MWH actually builds. Because we are not talking about small projects here, are we?
Not even close.
Yes.
Scale is the only way this toll booth model works. I mean, since 2008, MWH has constructed over 500 individual power plants.
500.
500. And that represents more than 21 gigawatts of clean generating capacity actually built and delivered to the grid.
Okay, hold on, wait. For those of us who, don't spend our days staring at utility transmission maps, what does 21 gigawatts actually look like?
It's a lot of juice.
Yeah, I mean, we hear gigawatts thrown around in movies like Back to the Future, but let's ground that. A typical nuclear reactor is usually around 1 gigawatt, right?
Yeah, roughly 1 gigawatt for a major modern reactor.
So we are talking about the equivalent of roughly 20 entire nuclear power plants worth of generating capacity that this one single company has built out.
That is exactly the right way to visualize it. And if you want to think about the physical land footprint, a 1 gigawatt solar facility requires roughly 5,000 to 7,000 acres of land.
Depending on the topography, I assume.
Right, depending on the hills and the dirt. So MWH has essentially blanketed over 100,000 acres of the United States with advanced solar arrays and battery storage.
That is just mind-blowing.
And currently, today, They manage nearly 22 gigawatts of active power plant infrastructure across 155 operating sites.
So they focus almost exclusively on what the industry calls mega-scale infrastructure.
Exclusively mega-scale, yeah. They are not out there bidding to build a 5-megawatt solar field behind a local grocery store.
Or like an Amazon fulfillment center roof.
Exactly, they don't touch that. Their projects routinely exceed 200 megawatts. And their current active pipeline features multiple massive developments scaling above 600 megawatts apiece.
Okay, so they are building the absolute largest infrastructure nodes on the American power grid. But let's look at the actual business model.
Right, the two engines.
Yeah, you called them a toll booth, but they really operate two totally distinct economic engines that feed into each other. One is EPC, which stands for Engineering, Procurement, and Construction.
That's the heavy lifting phase.
Right, the initial building phase. And the other is O&M, which is Operations and Maintenance.
And the synergy between those two engines is their absolute most significant structural moat. I mean, EPC is the high-velocity, top-line revenue engine.
That's where the big checks clear.
Exactly. That's where the massive multi-hundred-million-dollar contracts hit the books. As they roll heavy machinery into the desert, pour thousands of yards of concrete, drive millions of steel piles into the earth.
And wire up just like literal oceans of photovoltaic modules.
It is an incredibly intense logistical ballet. But the open secret of MWH's entire corporate strategy is that the EPC segment actually serves as massive customer acquisition funnel.
Right, it's a funnel for the true prize.
Yep, the prize is the long-term O&M service contract.
I love this part of the business model. I always compare it to the classic razor and blades model. It's like selling a printer at a very low margin just to secure a 35-year legally binding contract on supplying the ink.
That is a perfect analogy. The EPC segment is the printer.
Right. They build this massive 600-megawatt solar array, they lock in that physical footprint on the grid, and that initial build feeds directly into the long-term service contract.
They literally get paid to maintain the ink for decades.
Can we look at the numbers on that? Because I know you have the NREL data.
Yeah, the National Renewable Energy Laboratory data validates that analogy perfectly. If we look at their standardized unit economics, we can see exactly how this life cycle plays out.
Down to the penny.
Pretty much. According to NREL's baseline models, an owner of a utility-scale solar and battery project is going to spend roughly 82 cents per watt on the initial EPC construction phase.
Okay, so 82 cents a watt, that is the initial printer purchase. 82 cents to clear the land, drive the steel, and plug it in.
Right. And while 82 cents per watt sounds small, on a 600-megawatt plant, you're talking about nearly $500 million in upfront construction costs.
Which is massive revenue for MWH.
Huge revenue.
Yeah.
But the asset is expected to operate for 35 years. And over that 35-year lifespan, the owner is projected to spend about 20 cents per watt on routine preventative maintenance.
Okay, 20 cents.
Plus another 7 cents per watt on major corrective maintenance. And roughly 10 cents per watt on inverter replacements and upgrades.
So you have this massive, explosive upfront burst of revenue during the initial 2-year construction window.
Right.
Followed by 3.5 decades of highly predictable, high-margin recurring service revenue. And MWH is just perfectly built to capture that entire life cycle.
We go to a major developer and essentially say, we will handle the chaos of building your 600-megawatt plant in the Nevada desert.
Just let us build it.
Exactly. And once it is turned on, we will monitor it from our 24/7 control center in San Diego for the next 30 years.
But here is where it gets really fascinating to me. Because it's not just about sending a guy out in a pickup truck to squeegee a dusty solar panel every 6 months, is it?
No, not at all. It is about empirical data.
Because they currently manage 22 gigawatts across 155 different geographical sites. So they have built an incredibly powerful proprietary monitoring platform.
Right, the Vitals platform.
Let's unpack Vitals, because I feel like this is what elevates them from just a heavy construction company into an actual technology platform.
The sheer volume of telemetry flowing into the Vitals platform is honestly staggering. Through those systems, MWH is actively monitoring over 2 million distinct data points per second.
2 million per second across their entire national fleet.
Yes. They have accumulated over 50 terabytes of historical operating data. And that data is not just sitting on a server somewhere gathering dust.
Right, they actually use it.
They actively use it to shape how they build the next plant. I mean, they know exactly how a specific Tier 1 solar module degrades in the dry, intense heat of Arizona versus, say, the humid, salty air of the Texas Gulf Coast.
They know exactly which string inverters are likely to fail after 5 years.
Exactly. And under what specific voltage loads they fail.
Okay, stop right there, because I think this is the aha moment for the listener. Tell me how that data actually changes the physical reality of a new power plant.
Okay, let's use a very specific physical example.
Yeah, give me the mechanism. How does 50 terabytes of data turn into a competitive moat?
So when a solar array generates DC power, it has to be converted to AC power by an inverter before it can hit the grid.
Right, DC to AC.
Now, inverters get incredibly hot, and if they overheat, they throttle their output.
Meaning what? They just shut down.
They basically slow down to protect themselves from melting, which means the power plant is losing money because it's generating less power.
Okay, I follow.
Because MWH has 50 terabytes of data, they know that when a specific brand of inverter hits, say, 110 degrees in the Mojave Desert, it drops its efficiency by 4%.
So they know the exact failure point.
Right. So when they are bidding on a brand new 600 megawatt EPC contract, they don't just draw a standard blueprint. Their engineers use that data to physically redesign the layout.
Oh, wow.
They might angle the adjacent solar panel structures to cast a precise shadow over the inverter box exactly at 2 p.m. during the peak heat of the day.
Wait, really? Just by angling a panel?
Yes. So by simply designing a shadow into the blueprint, they prevent the inverter from throttling.
And they save the developer millions of dollars in lost yield over a 35-year lifespan. That is incredible.
It's exactly that. So when a massive energy developer comes to the market with a billion-dollar project, MWH isn't just offering a standard construction bid based on some theoretical estimates.
They are sliding 50 terabytes of empirical proof across the table.
Exactly.
Yeah.
They are showing the developer exactly how to optimize the physical design to maximize yield and minimize O&M costs over the next 3 decades.
And that right there creates an unassailable tech-enabled moat. I mean, no new, heavy civil competitor can just decide to enter the solar market tomorrow and instantly spin up a 50-terabyte database of historical, granular performance data.
No, it takes a decade of actual operations to build that kind of data set.
Okay, so if they are leveraging this data moat to lock in these massive multi-decade contracts, the logical next step for us is to look at their actual pipeline.
The backlog.
Right, because a moat is only as good as the water inside it. We need to dissect this backlog. How much guaranteed work is actually waiting to be built? And crucially, who is signing the checks?
Right. Well, the backlog is the lifeblood of any infrastructure company. And MWH's figures are massive, but they do require a rigorous audit to really understand them.
Yeah, the SEC filings get a bit dense here.
Very dense.
Yeah.
In their official Q1 2026 earnings release, MWH reported a formally contracted backlog of $8.2 billion.
$8.2 billion.
Which represents an 82% year-over-year increase, which is just phenomenal growth.
But wait, if you read the institutional analyst notes covering the stock, they frequently reference a gross pipeline approaching $10 billion.
Right, there's a discrepancy there.
Let's unpack that discrepancy. As an investor looking at the stock, $8.2 billion versus $10 billion is a massive $1.8 billion delta. Why is there a difference, and which number actually reflects reality?
Well, both numbers reflect reality, but they reflect completely different stages of the corporate accounting lifecycle.
Oh, I see.
Institutional financial analysts track the entire ecosystem. So they look at that gross pipeline of roughly $10 billion, and they split this into about $3.1 billion of what they call funded backlog and about $6.9 billion of unfunded backlog.
Okay, let me guess. Funded means the money is sitting in an escrow account, fully cleared and ready to be deployed into the dirt tomorrow.
Very close. Funded backlog means the project is highly active. It has fully cleared capital market audits. The developer has secured strict debt retirement controls and project financing from the major banks.
So it's a go.
Right. It has immediate revenue velocity for MWH. The equipment is literally being ordered, the dirt is being moved.
And the unfunded backlog, that makes up the larger $6.9 billion portion of that gross analyst estimate.
Unfunded represents conditional pipeline volume.
Conditional meaning it could just fall apart entirely.
Exactly. What stops an unfunded project from becoming funded? It's a myriad of macro factors. An unfunded project might be facing massive regulatory reporting lags at the state level.
Oh, local politics.
Politics, permitting. It might be facing multi-year delays to secure high-voltage transmission rights from the local utility grid.
Or environmental stuff, right?
Yeah, it might simply be caught in localized exploration and permitting slowdowns.
Sure.
Perhaps they found an endangered tortoise on the site and have to relocate it before they can pour concrete.
So because of all these variables, Management at MWH employs incredibly strict accounting standards for what they officially report to the SEC in that $8.2 billion figure.
Highly conservative. They don't count their chickens before they hatch.
Yeah, I know from the source material that they strictly exclude verbal awards from their official SEC backlog. Like, if a developer calls them up and says, hey, you won the bid for the Texas project, we'll sign the papers next month, MWH does not put that in the official 8.2 billion number until the ink is actually dry.
They absolutely do not. Management splits that official 8.2 billion SEC backlog into two specific categories, signed and awarded.
Okay, what's the difference there?
Signed backlog means MWH holds legally enforceable rights to consideration. This means they have an executed EPC contract with a full notice to proceed. Or it represents the guaranteed minimum amounts due under a currently active O&M agreement.
And award?
Awarded backlog means the customer has legally agreed upon a price framework and signed an initial limited notice to proceed, but the final massive lump sum construction contract hasn't been fully executed yet.
Right. Well, we need to look at the internal composition of that 8.2 billion, because if we go back to our printer and ink analogy,
The volume imbalance is wild.
it is wild. The core construction, the EPC side, the printer, makes up roughly 7.63 billion of that official backlog. That is 93% of the total pie.
Yep.
And the O&M segment, the ink, is only locking in roughly 574 million, which is just 7%. So if the O&M is only 7% of the contracted backlog, why is the market treating it like the absolute crown jewel of the company?
Because the market looks past the raw top-line dollar amount and focuses on the duration and the quality of the cash flow.
Ah, right, duration.
That 7% represents the long-term compounding engine of the entire enterprise.
Yeah.
I mean, while the O&M dollar figure looks relatively small when stacked next to a $600 million construction job, it holds a 100% historical renewal rate.
100%.
Yes. Once MWH is embedded as the operator, the developer essentially never fires them. Furthermore, O&M operates with a structurally much higher margin profile than heavy civil construction.
Well, sure, because construction is a brutal, low-margin business exposed to literally everything under the sun.
Literally everything. Heavy construction is immensely capital-intensive. You're exposed to catastrophic weather delays, supply chain shocks, labor shortages, and raw material inflation.
Steel prices, all of it.
All of it. O&M, by contrast, is an asset-light, highly predictable annuity. You are bypassing heavy equipment costs and massive capital depreciation. You're mostly just paying for specialized software monitoring and targeted, scheduled technician deployments.
So while the massive 7.63 billion EPC backlog provides the high-velocity revenue needed to scale the business today, the O&M backlog is what actually builds the high-margin, unbreakable financial fortress over time.
That's the perfect way to look at it.
Let me push back on that fortress concept, though.
Okay, go for it.
If we look at who is actually paying MWH for all this work, there is a massive, glaring counterparty concentration risk in these filings.
Oh, the top 10 numbers.
Yeah, the top 10 numbers. In 2025, MWH's top 10 developer clients accounted for 73% of their total revenues. And in the first quarter of 2026, that concentration spiked to 81%.
Right.
In fact, their single largest individual customer made up 21% of their entire revenue in Q1. If I am an investor, and you are telling me that an $8 billion business relies on essentially 10 companies for 80% of its cash flow, I am terrified. Isn't that incredibly dangerous? If one of those developers goes bankrupt, MWH takes a massive hit.
Well, in a standard retail business or like a software as a service company, yes, that level of concentration would be an immediate red flag. But the common trap here is thinking about utility-scale infrastructure like a normal consumer market.
How so?
If we connect this to the bigger physical reality of the global power grid, you have to remember that there are only a handful of corporate entities on planet Earth with the balance sheets required to commission multi-gigawatt power plants.
Oh, that makes sense.
MWH's clients are massive independent power producers, major regulated monopoly utilities, and elite, well-capitalized developers.
Okay, for the uninitiated listening, let's define that. What is an independent power producer, or IPP, and how is that different from the utility company that sends me my monthly electric bill?
A regulated monopoly utility, like Pacific Gas and Electric or Duke Energy, typically owns the whole ecosystem in a specific region. They own the power plants, the transmission lines, and a billing relationship with your house.
Right.
An independent power producer is a private corporation that simply builds massive power plants and then sells that power wholesale into the open grid markets.
So they don't deal with consumers at all.
Not at all. IPPs don't care about the power lines leading to your house. They just generate the raw electricity at a massive scale and sell it to the highest bidder, often signing long-term power purchase agreements directly with hyperscale data centers or major tech companies.
Ah, there's the AI connection again.
Exactly.
Hmm.
And because these IPPs are operating at such an immense scale, the industry naturally consolidates at the top. I mean, MWH currently works with 65% of the top 25 solar developers in the United States.
So the customer base is concentrated simply because the industry itself is an oligopoly. You physically cannot build these assets without being a multi-billion-dollar titan.
Precisely. Let's look at one of their major developer relationships to see how this scale actually works in practice. Take their partnership with Sol Systems.
Right, Sol Systems is a huge player.
Yeah, they are a leading elite national clean energy developer. And MWH is currently acting as the primary EPC provider for Sol Systems' Nightfall solar project down in Uvalde County, Texas.
The Nightfall project.
Yeah, that project is a 180 megawatt installation. It is a massive physical undertaking projected to power nearly 58,000 homes.
And Nightfall is just one localized piece of this massive 4-gigawatt pipeline of mega projects they are currently executing across the country.
Just one piece.
The scale of these individual contract awards is mind-blowing when you read the list. They recently secured a 1,200-megawatt multi-phase award in Arizona, which is the largest single award in the history of the company.
A 1,200 megawatt beast.
Yeah. And that mega project includes the solar arrays, the battery energy storage systems, or BS, and the SCADA control systems. Let's pause there. What exactly is a SCADA control system, and why is it important that MWH is building it?
Okay, SCADA stands for Supervisory Control and Data Acquisition.
Hmm.
Think of a 1,200 megawatt power plant like a massive distributed organism covering 10,000 acres.
Okay, an organism.
You have millions of individual solar panels, thousands of inverters, massive substations, and rows of lithium-ion battery containers. SCADA is the centralized brain in the central nervous system.
Oh, I see.
It is the complex software and hardware network that allows human operators in a control room to actually monitor the voltage, open and close physical circuit breakers, and safely route the power to the grid.
So if the SCADA system fails...
The power plant goes blind. It has to be shut down immediately to prevent a catastrophic grid failure.
And the fact that MWH handles the SCADA integration in-house rather than subcontracting it out to a specialized software firm, that must be a massive competitive advantage.
Huge advantage. It ensures the plant's brain is perfectly integrated with the physical hardware from day one.
So they have this 1,200 megawatt beast in Arizona. They have another 1,150 megawatts under contract in Texas. They have 910 megawatts in Nevada and a 650 megawatt anchor project on the East Coast in North Carolina.
The volume is just wild.
It is. But this brings me back to the risk profile of the EPC engine. When you are building at that scale, committing to a 1,200 megawatt lump sum contract, you are inherently taking on massive financial risk.
Oh, absolutely.
I mean, what if you sign the contract and then 3 months later, global steel prices double? Or what if a custom high-voltage transformer is delayed by 9 months because of a supply chain shock in Asia? A fixed lump sum contract sounds like a great way to go completely bankrupt if the macro environment shifts against you during a multi-year build.
And you just hit on exactly what destroyed several legacy heavy civil contractors during the post-pandemic supply chain crisis.
They got caught holding the bag.
They absolutely did. They signed massive lump sum EPC contracts. The price of polysilicon and logistics tripled, and their profit margins were instantly vaporized.
So how did MWH survive that?
They survived and thrived through that period because of their incredibly disciplined contractual architecture. They protect themselves by utilizing what the industry calls LNTPs, limited notice to proceed agreements.
Okay, walk me through the mechanics of an LNTP. How does a piece of paper stop MWH from absorbing a spike in steel prices?
It acts as a phased financial shield. Before MWH ever commits to a final, legally binding, fixed lump sum price for that massive Arizona plant, the developer must sign an LNTP.
What does that do?
Under the LNTP, the developer is required to release targeted capital to pay for all the initial high-risk exploration. The developer pays for the deep soil geotechnical testing to make sure they aren't, trying to drive steel into solid bedrock.
Right.
The developer pays for the preliminary engineering designs. And most crucially, the LNTP requires the developer to fund all the upfront financial deposits required to order the long lead equipment.
Oh, like the custom high voltage transformer.
Exactly. The transformers, the battery modules, and the solar panels.
Ah, I see. So MWH essentially forces the client to lock in the volatile supply chain costs and identify all the hidden rocks in the dirt before MWH ever guarantees the final price tag for the overall construction.
Exactly. By the time MWH actually signs the final lump sum EPC contract, the physical supply chain is already secured. The prices for the major components are locked, and the geotechnical risks of the site are fully known.
That's brilliant.
It completely insulates MWH from sudden external supply chain shocks or unexpected civil engineering nightmares.
Mm.
Furthermore, they build strict tariff pass-through clauses into these final contracts.
Pass-through clauses, meaning?
Meaning, if the federal government suddenly slaps a massive new import duty on foreign solar panels halfway through the project, that cost is legally passed directly through to the developer. It does not hit MWH's margins.
Wow.
They also require structured monthly progress payments based on construction milestones, ensuring they are never deeply out of pocket if a developer suddenly goes insolvent mid-build.
Okay, so we've established that the contracts are virtually bulletproof. But what does this actually mean for the boots on the ground?
The labor force.
Right, because to physically execute a 1,200 megawatt project in Arizona while simultaneously building a 650 megawatt project in North Carolina, operating across 41 different states, you need an absolute army of workers. You can't just hire a few local electricians.
No, you need a massive, coordinated effort.
How does MWH's workforce model compare to the legacy infrastructure giants they are constantly bidding against?
The competitive labor landscape is really fascinating here. MWH is going head-to-head with massive publicly traded peers like Quanta Services, Mastech, and Primora Services. They also routinely bid against massive, privately held heavy civil builders like Hewitt and Mortensen.
And this is where the renewable purity advantage really shines, right?
Exactly.
If you look at a competitor like Quanta or Primoris, they are incredible, highly respected companies, but they carry heavy historical exposure to legacy infrastructure. They build petroleum pipelines, they build natural gas distribution networks, they do traditional fossil fuel civil works.
Right.
MWH carries absolutely zero fossil fuel baggage. They act as a pure play, specialized filter for the renewable grid and battery storage sectors.
That pure play focus is critical, but it extends directly into how they manage the actual humans swinging the hammers. To deploy physical infrastructure at this scale, secondary financial analysis frequently cites that MWH leverages a massive, flexible craft workforce of roughly 9,000 workers.
Okay, now this is an investigative puzzle I really want to unpack for the listener. If you go look up MWH's official SEC filings right now, like S1 or their annual 10K, you are going to see a bizarrely small employee headcount reported.
Yes, you are.
The SEC filing suggests they have a relatively tiny workforce, but the analyst reports and the secondary data clearly state they deploy an army of 9,000 workers. As an investor, your first thought is going to be, wait, how is a skeleton crew building 20 nuclear plants worth of solar? What is the trick here? Why the massive discrepancy?
Well, that discrepancy isn't a mistake. It is the absolute key to their entire labor arbitrage strategy.
Yeah, explain that.
The small headcount reported in the strict SEC filings represents their core, salaried corporate employees. That is the specialized engineering team in San Diego, the corporate management layer, and the permanent O&M technicians who monitor the Vitals platform.
Right.
The 9,000 figure represents their agile multi-state deployment model for the EPC construction wing. MWH aggressively scales their hourly craft workforce up and down dynamically, entirely based on active project demands. They aren't carrying 9,000 salaries on the books when there isn't actively dirt being moved.
Let me play devil's advocate here. How is that functionally different from what Quanta or Mastech or Hewitt does? Doesn't every massive construction company just hire temporary local construction workers when they win a big job?
The critical difference is unionization and legacy labor frameworks. Legacy competitors like Quanta and the historical heavy civil mega builders are heavily bound by rigid legacy union work rules.
Oh, the union rule.
Yes, they are tied to incredibly strict geographic collective bargaining agreements.
So, if a union contractor finishes pouring concrete for a massive substation job in Nevada on a Friday, they can't necessarily just load that exact same experienced crew onto a fleet of buses, drive them across the border, and start driving steel piles for a new solar array in Texas on Monday morning.
Absolutely not. Under many collective bargaining agreements, they would have to hire from the specific local union hall in Texas, dealing with entirely new crews, new jurisdictional rules, and strict demarcations of labor.
Right.
Furthermore, An electrician cannot do the job of an iron worker, and an iron worker cannot do the job of a heavy equipment operator. They also carry massive long-tail financial liabilities associated with multi-employer pension plan exposures.
Which are notoriously complex and underfunded.
Very much so. It's the legacy baggage of operating a century-old infrastructure conglomerate.
And MWH?
MWH, on the other hand, utilizes a massive, predominantly non-union field force. This self-perform autonomy allows them to execute rapid cross-training. An MWH field worker can be trained to pull low-voltage wire one rung, and then easily shifted to assembling the physical steel tracker tubes the next week if the project timeline demands it.
That flexibility is huge.
It is. There are no strict jurisdictional lines preventing them from optimizing the labor pool on the site. And critically, MWH can seamlessly shift those highly trained, specialized mega-project workers across state lines without hitting severe geographic union bottlenecks.
So that agility directly translates to the bottom line, because they aren't paying idle workers to sit around, they aren't restricted by rigid jurisdictional work rules, and they aren't dealing with multi-employer pension liabilities. They can optimize their labor productivity to an extreme degree. That explains how they managed to print a highly efficient 18.6% gross margin for the full year 2025. I mean, I have covered heavy construction for a long time, and hitting nearly 19% gross margins while doing the brutal physical work of building gigawatt-scale infrastructure is incredibly difficult. Most heavy civil firms are thrilled to hit 10 or 12%.
It is a testament to their strict project margin controls during these intense competitive bidding cycles. They aren't just winning these massive contracts by being the cheapest bid on the table and sacrificing margin.
Right.
They are winning bids because their non-union, cross-trained labor pool allows them to physically execute the timeline faster and with more predictability than a legacy conglomerate bogged down by local labor disputes.
Okay, so MWH can handle the logistics. They can clear the land, they can build the solar arrays with their agile workforce, they can procure the massive battery banks. But here is where we hit the macro bottleneck of the entire AI revolution.
The grid itself.
Yes. What happens when the broader utility grid itself is functionally frozen? Because right now, every major tech company on Earth wants to build multi-gigawatt AI data centers, and those data centers need immense amounts of power.
This raises a very specific question about MWH's macro positioning, and we have to be clear about what they do. Management has explicitly confirmed on their Q1 2026 earnings call that MWH does not currently build what we call behind-the-meter projects for off-grid hyperscalers.
Meaning they aren't building private, totally disconnected power plants specifically for one Google or Microsoft data center sitting out in the middle of nowhere.
Right. They are building utility-scale assets that feed the broader national grid, but they are perfectly positioned to feed the macro load growth that those specific data centers are pulling from the grid.
But the grid is choked.
Exactly. As you noted, the entire system is bottlenecked. You can build the most efficient, beautifully designed 600-megawatt solar farm in the world, but if you cannot plug it into the high-voltage transmission network, it is just an incredibly expensive collection of glass and steel baking in the desert.
The primary roadblock for all of this renewable and AI growth is the high-voltage grid interconnection queue.
It's a massive issue.
The interconnection queue is the single biggest nightmare for renewable developers right now. Waiting for the local monopoly utility to come out and build a massive electrical substation to connect your new solar plant to the grid can take anywhere from 3 to 7 years.
Which completely destroys the financial models of these developers.
And this brings us to what I think is one of the most brilliant strategic chess moves MWH has made: the acquisition of Roberson Waite Electric, or RWE.
It was a highly targeted surgical acquisition. In May of 2026, MWH acquired RWE for $45 million. And critically, they structured the deal so that $36 million of that was paid up front, funded entirely by cash on hand from their balance sheet.
So no debt.
They didn't dilute their public stock. They didn't take on massive new debt tranches. They just paid cash.
What exactly did they buy for $45 million in cash? Because a mid-sized electrical contractor doesn't sound like a game changer on the surface.
They bought an incredibly specialized capability. RWE is a contractor founded back in 1975 with decades of deep, entrenched experience supporting safety-critical substation projects for the major electric utilities in Southern California.
Okay.
By acquiring RWE, MWH brought turnkey, high-voltage utility substation construction, testing, and commissioning entirely in-house. And RWE handles systems scaling up to 500 kilovolts, which is massive interstate transmission-level power.
Let's use a physical metaphor here for the listeners because 500 kilovolt substation can sound pretty abstract.
Yeah, let's ground it.
Think of the main interstate transmission lines, the massive steel towers you see driving across the country. Think of those like a massive industrial fire hose blasting water at 1,000 pounds per square inch. It is an immense amount of raw energy.
Right.
You cannot just plug your kitchen sink or even a local factory directly into that fire hose. The pressure would cause it to instantly explode. The high voltage substation is the massive, highly engineered industrial pressure valve. It safely takes that 500 kilovolt fire hose and steps the voltage down to a manageable stream that a local battery bank or an AI data center can actually swallow without burning to the ground.
That is the perfect way to visualize the physics of it. So by embedding RWE's highly specialized substation expertise directly into their in-house platform, MWH establishes what we can call Substation Alpha.
Substation Alpha.
They no longer have to wait years for the local utility or a third-party subcontractor to build that critical pressure valve. They just build it themselves.
So they basically bought the rights to build their own off-ramps onto the grid. You can build all the solar panels you want, which is the highway, but without the off-ramp, you can't deliver the product. They completely bypass the severe high-voltage interconnection delays that are currently freezing all these data center build-outs.
Exactly. And if we connect this Substation Alpha concept to the bigger picture of MWH's historical corporate strategy, you have to look at their previous quiet acquisition of a company called Spartan Infrastructure.
Spartan, what do they do?
Spartan is a highly specialized contractor that builds high-voltage transmission and distribution lines.
The actual wires connecting the plant to the grid?
Right, the wires. Now, take a step back and look at the combined platform. You combine the Spartan wires with the RWE substations and the core MWH mega project EPC business.
Oh, they control everything.
MWH can now act as a single, comprehensive umbrella for the most complex mega projects on Earth. Spartan builds the transmission lines over the mountains. The core MWH EPC team clears the desert and builds the massive solar array and the battery banks. And then RWE builds the critical high-voltage substation to safely step the power up and connect the entire facility to the interstate grid.
MWH doesn't have to subcontract a single piece of the critical path. They control the entire timeline.
And there's another huge strategic layer to the RWE acquisition that stood out in the sources. RWE isn't just building these substations in empty fields. They have deep, specialized expertise executing in complex brownfield sites and highly dense urban environments in Southern California.
Why does urban expertise matter for a company that normally builds massive sprawling projects out in the open desert?
Because the nature of the power grid is shifting, largely driven by stationary battery storage. As CEO George Hirschman explicitly noted when discussing the acquisition, the U.S. grid desperately needs localized energy storage.
Because of the massive spikes in power demand.
Exactly. Placing standalone, high-capacity battery storage systems directly into dense urban load centers, like downtown Los Angeles or Chicago, is often the only viable solution for cities that are experiencing massive spikes in power demand from data centers or electric vehicles, but have absolutely no physical space or political permitting ability to string new overhead high-voltage transmission lines through neighborhoods.
So RWE's urban substation expertise allows MWH to navigate incredibly tight, complex city layouts and drop massive battery banks right into the middle of a city's existing, aging electrical infrastructure.
Right. It opens up a whole new market for them.
Okay, so let's summarize the operational reality we've established. MWH has an absolutely unassailable operational moat. They have the 50 terabytes of vitals data, allowing them to optimize designs. They have an $8.2 billion contracted backlog with a gross pipeline approaching $10 billion. They have an agile, non-union labor force that prints nearly 19% gross margins. And now they own a Substation Alpha to bypass the gridlock entirely.
Good juggernaut.
It is. So with a business this structurally sound, this dominant in its niche, how did Wall Street actually react to MWH's entry into the public markets? Because looking under the hood of their corporate architecture, things get incredibly complex and, frankly, a bit predatory very fast.
Yeah, to truly understand their public valuation and the initial stock volatility, we have to execute a rigorous forensic audit of their corporate governance.
Let's do it.
MWH was not some plucky startup built from scratch in a Silicon Valley garage. It was formed in December of 2021 as a highly engineered corporate carve-out of a legacy company called Swinnerton Renewable Energy.
And it was carved out by a private equity sponsor.
Yes, specifically by the massive private equity firm, American Securities, LLC. And when a sophisticated private equity sponsor brings a highly profitable company to the public markets via an initial public offering, they almost always structure the governance to maintain absolute control while simultaneously extracting liquidity for themselves.
Right.
To achieve this, American Securities utilize what is known as a complex up-C split-stream corporate structure.
Okay, let's unpack the Up-C structure for the listener because it is a classic, deeply complex private equity governance trap that catches a lot of retail investors off guard.
It really does.
Under the structure, MWH operates with a dual-class share system. They have over 115 million Class A shares floating around. Those are the regular shares that you or I, or a standard mutual fund, buys on the open market.
Right, the public shares.
But then they have over 87 million Class B shares, which are held tightly by the legacy private equity owners and the founders. What is the actual difference in the voting power between these two classes?
The disparity is massive, and entirely by design. The public Class A common stock captures the economic interest of the company. If the company make a profit, the Class A shares theoretically capture that value.
Okay.
However, despite holding the economic risk, the Class A shares command a minor, almost irrelevant 9.5% of the total voting weight in corporate matters.
Wow.
By contrast, the Class B shares, which are strictly non-economic, are engineered to hold a definitive 95.5% voting supermajority.
Hold on, let me just repeat the sheer audacity of that structure.
Yeah.
95.5% voting supermajority for the insiders. You are telling me that I can log into my brokerage, buy this stock, put my hard-earned capital entirely on the line to fund their operations, and I have absolutely zero say in whether they decide to sell off half the company tomorrow or fire the CEO or change the entire business model.
That is exactly what I'm telling you. This dual-class structure legally designates MWH as a controlled company under strict NASDAQ listing rules. It legally concentrates ultimate, unassailable corporate authority entirely with the private equity sponsor, American Securities, and their affiliated legacy holders.
So they can just do whatever they want.
Pretty much. Because they are a controlled company, they are legally exempt from standard corporate governance requirements. They have the explicit right to completely revoke board and committee independence protections at any time without consulting the public Class A shareholders.
So if you buy MWH stock, you are strictly a passenger. American Securities is driving the car, and they have locked the steering wheel.
Exactly. And the rabbit hole gets deeper.
Oh, great.
Because strictly speaking, the public company you are buying, SOLV Energy, Inc., is just a holding company. It doesn't actually conduct any physical business operations of its own. It doesn't own the bulldozers or the software.
What does it own then?
Its only material asset is its ownership of LLC interests and a lower-level entity called SOLV Energy Holdings, LLC. And this tiered structure triggers something called a tax receivable agreement.
Can you explain what a step-up in basis is and how this TRA essentially traps the cash flow away from public shareholders?
Yeah. A tax receivable agreement, or TRA, is a highly lucrative feature frequently embedded in these private equity Up-C structures. When the company went public and restructured, it created what tax accountants call a step-up in basis for the underlying assets.
Which means what exactly, in plain English?
In plain English, it means they artificially revalued the company's historical assets at a much higher current market price for tax purposes. Because the assets are now valued higher on paper, the company can claim massive depreciation deductions against their future taxes.
Okay.
It essentially shields the newly public company from paying hundreds of millions of dollars in future corporate income taxes.
Well, that sounds great for the company. Less taxes means more profit, right?
It would be great if the public company actually got to keep the savings.
Yeah.
But the TRA legally requires the newly public company to pay a massive portion, usually 85%, of all those cash tax savings directly back to the pre-IPO legacy owners.
The private equity firm.
Exactly. So the public company generates the profit, uses the accounting trick to avoid the taxes, but then has to hand the cash they saved right back to the insiders.
That is wild.
Furthermore, if you read the fine print, SOLV Energy Holdings LLC's ability to pay any cash dividends up to the public company and eventually to you, the retail shareholder, is currently heavily restricted by the strict covenants of their new revolving credit facility and their distribution requirements to those legacy LLC interest holders.
So if you are a retail investor buying MWH hoping they're going to initiate a quick, fat dividend yield to share the massive profits from their O&M Tollbooth, you're looking in completely the wrong place. The cash is currently legally constrained by debt covenants and complex tax obligations flowing back to the private equity sponsors.
Correct. You are buying this for structural capital appreciation driven by the backlog, not for near-term dividend yield.
Mm-hmm.
And this complex, heavy-handed corporate architecture absolutely played a role in the severe volatility we saw following their initial entry into the public markets.
Let's talk about that post-IPO market reaction, because if you look at the chart, it looks like a roller coaster.
It really was.
They executed a late May 2026 public offering that was officially priced at $36 per share. Initially, the reports indicate it met with heavy institutional demand. The big banks wanted in. But it also triggered an upsized 15 million share supply shock into the market.
Right.
The stock almost immediately dragged down from its 52-week highs, tumbling all the way down to the $30 range. And part of what deeply spooked retail investors, the folks reading the headline news algorithms, was that in their first major report, the company printed a technical GAAP net loss.
Right. And this is a classic example of why you cannot trade complex infrastructure stocks based purely on algorithmic headline summaries. You have to look past the headline, GAAP net loss. In the full fiscal year of 2025, MWH practically doubled its adjusted EBITDA, driving it to a massive $342 million. They are printing incredible, sustained top-line revenue growth across all of those mega projects we discussed.
So the obvious question is, how do they show a GAAP net loss while simultaneously pulling in record revenue? If the EPC engine is humming in the desert and the O&M Tollbooth is quietly collecting its high-margin cash every month, where on earth did the loss come from?
It was almost entirely an accounting artifact. The GAAP net loss was heavily influenced by approximately $65 million in non-cash compensation expenses recorded in the first quarter of 2026 alone.
You're talking about stock-based compensation given to executives and employees during the IPO.
Exactly. When the company goes public, millions of shares of restricted stock suddenly vest. And under GAAP accounting rules, the company must record the theoretical value of those shares as a massive expense on the income statement.
But crucially, it is a non-cash expense.
Exactly. The company did not actually write a $65 million check and drain their bank account. It does not reflect any degradation in the cash-generating ability of the underlying physical business.
Okay, that makes sense.
This is why Wall Street's institutional buy-side analysts, the people who actually move the markets, have aggressively re-rated the valuation to look right past this technical GAAP net loss. The major institutions are not pricing MWH based on a one-time Q1 stock comp accounting charge.
They are pricing in the reality of the $10 billion gross backlog.
Right. They're pricing in the highly lucrative compounding O&M Tollbooth that currently manages 22 gigawatts of infrastructure and grows every single time they finish pouring concrete.
So, to summarize the core journey we have taken today, MWH is not some speculative, catch-burning battery manufacturer hoping to invent a miracle chemistry.
Definitely not.
They are the premier pure-play infrastructure toll booth for the American renewable grid. They utilize an incredibly agile, non-union workforce to drastically undercut legacy civil engineering competitors, printing nearly 19% gross margins on multi-state gigawatt-scale mega projects.
Right.
They strategically acquire niche assets like RWE to build Substation Alpha, effectively creating their own grid off-ramps and completely bypassing the interconnection bottlenecks that are currently starving the AI revolution of power.
Yep.
And most importantly, they use their massive multi-billion-dollar EPC construction wing as a subsidized customer acquisition funnel to lock in 35-year high-margin O&M annuities. You buy the printer, they sell you the ink for 3 decades.
That captures the mechanical thesis perfectly.
Aye.
But as we wrap up, I want to leave you with a macro forward-looking concept to mull over.
Okay, lay it on me.
We have spent this entire deep dive talking about massive 1,200 megawatt solar fields spanning thousands of acres in the open deserts of Arizona and Nevada. That is MWH's historical bread and butter. But the landscape is shifting rapidly. As AI data centers consume exponentially more power, and as the traditional macro utility transmission grid continues to fundamentally fail at delivering that power efficiently over long distances, the hyperscalers, the Googles, the Amazons, the Microsofts, they are beginning to look at localized nuclear small modular reactors or entirely off-grid microgrids.
It's a fascinating pivot. The fundamental definition of what constitutes a power plant is shifting right under our feet. It's moving from an open desert solar field connected to a 500-mile transmission line to a hyper-dense, localized urban battery bank or a hybrid power node located literally next door to the server farm.
Precisely. And so the provocative question for you to consider as an investor tracking this space is this. How will MWH's lifecycle tollbooth model adapt to a world where the power grid is no longer a sprawling, interconnected national web, but instead fractures into a highly localized, fragmented network of off-grid microreactors and independent urban battery nodes?
That's the billion-dollar question.
It is. Will their legacy scale, their ability to deploy 9,000 workers into the open desert, translate seamlessly to the complex, hyperdense, localized power demands of the AI future? Or will the tech giants eventually bypass them by building their own captive power?
I think the RWE acquisition proves they are already trying to answer that question by moving into urban substations, but it is going to be the defining tension for the stock over the next 5 years. Will they build the microgrids, or will they be left building solar in the desert while the data centers go nuclear? It is an incredible dynamic. Thank you so much for joining us on this deep dive. Whether you are managing an infrastructure portfolio, tracking the mechanics of the AI boom, or just trying to understand how the lights actually stay on when you ask ChatGPT a question, I hope you walk away from this looking at the physical power grid through an entirely new lens. Keep watching the dirt, keep watching the backlog, and until next time.